SCHY in $100,000. Will it be a great jigsaw to SCHD? Imagine you're investing in SCHD. It's an ETF focusing in U.S. companies. So you were pretty confident that by your retirement in the next couple decades, you would keep smiling to the bank. But as your portfolio grows, you know better. You have observed the U.S. stock market getting higher and higher. So you're also afraid of a market crash that could ruin your future retirement plan. This is where the great jigsaw comes in. You can be relieved by diversification to SCHY. Today we will be sharing how to fortify your portfolio under SCHD by diversification to SCHY. By combining SCHY with SCHD, you don't only achieve portfolio growth, you also balance exposure with companies in the US and non-US companies around the world. Even better, with $100,000, you can grow a portfolio value of over $5.4 million, thereby setting yourself up for a happy life after retirement. What is SCHY and SCHD? SCHD and SCHY are both exchange-traded funds, ETFs, offered by Charles Schwab. They are designed to help investors grow their money through stocks that pay dividends. We spoke about SCHD at length in our previous video, but here's a quick refresher. SCHD is an ETF that focuses on U.S. companies that consistently pay good dividends. Its goal is to help you invest in strong, stable American companies with a track record of paying and growing dividends. So if you are an investor looking for income and growth from large U.S. companies like Pepsi, Home Depot, or Pfizer, then SCHD is for you. Now, for the star of the show, SCHY. This stands for Schwab International Dividend Equity. Launched on April 28, 2021, its primary focus is companies outside the U.S. that pay dividends. With SCHY, you can invest in high-quality international companies in countries like Japan, Germany, or the UK. The UK alone makes up 14.2%, Australia makes up 13.3%, France 11%, while Japan and Switzerland make up 9% individually. So if you are the type of investor who is seeking global diversification and income from stocks around the world, then SCHY is for you. By definition alone, you must have already spotted a couple of key differences. SCHD focuses only on U.S. companies, while SCHY focuses on companies outside the U.S. While both ETFs aim to provide regular income through dividends, SCHY offers international exposure by adding more diversity to your portfolio. One good thing though, both ETFs are low cost, making them attractive options for long-term investors. Holdings in SCHY and SCHD? SCHY impressively holds a portfolio of 100 companies across various international markets. On close examination of the companies it holds, it is clear that this ETF primarily focuses on large-cap stocks with strong dividend yields. SCHY tracks the Dow Jones International Dividend 100 Index and applies criteria such as dividend sustainability, liquidity, and financial health to select its holdings. This diversified income-focused approach helps provide exposure to international markets while managing risk. Let's begin with Unilever. Due to its strong global presence and reliable dividend payouts, this multinational consumer staples company is often included in dividend-focused ETFs like SCHY. Unilever is known for paying consistent and reliable dividends backed by stable cash flows from its diverse product portfolio. Its dividend yield is often above 3%, making it attractive for income-focused investors. Let's also consider Total Energies SE. This is one of the world's largest integrated energy companies, as it operates across renewable energy, electricity, and of course, oil and gas. Aside from positioning itself as a leader in the energy transition, with ambitious goals to diversify its portfolio beyond fossil fuels, Total Energies has a long history of paying high dividends, which are attractive to income-focused investors. The company's strong cash flows from traditional oil and gas operations help support its dividend payouts while funding its transition to renewable energy. Despite industry challenges, Total Energies has prioritized maintaining dividends even during the oil price downturns. As a major player in energy, Total Energies provides SCHY with exposure to a sector that benefits from rising energy demand and plays a key role in the global economy. Next is Roche Holding AG, a pharmaceutical and diagnostics leader known for cancer treatments and innovation in diagnostics. Roche has a strong focus on research and development, with significant annual investments supporting its robust drug pipeline. They also have a long history of stable and growing dividends. They have been known for maintaining a shareholder-friendly payout policy, with dividends increasing annually for over 3 decades. Roche typically offers a dividend yield between 2% and 4%, supported by strong cash flows from its pharmaceutical and diagnostics businesses. Notice any common denominators among these companies? That is the beauty of SCHY. From financial stability to strong international presence and consistent dividend policies, you will find that all of these companies exemplify the characteristics that SCHY seeks. Their inclusion provides diversification across sectors and geographies, while also reducing overall portfolio risk. Moving on to SCHD's portfolio. It includes notable U.S. companies from diverse industries. A good mention would be Verizon. This renowned global communications technology company has demonstrated resilience by maintaining its 17-year streak of increasing dividends. Home Depot. As a multinational home improvement retail corporation, Home Depot makes up 4.4% of SCHD. Supported by sustained demand in the housing market, the company offers a 2.8% dividend yield, which it has increased for 24 consecutive years. Now, these are just a few. It is a long list of reputable companies like Pfizer, BlackRock, Coca-Cola, and so on. The point is that these companies exemplify the focus of SCHD on financially strong firms with a consistent record of dividend growth. We have a more detailed video about SCHD. You might want to check that for more information. Historical performance of SCHY and SCHD. By focusing on high dividend-yielding companies outside the U.S., SCHY has delivered a cumulative total return of approximately 11.1% since its inception in April 2021. Impressive, right? This, of course, is dependent on the fact that reinvestment of dividends is applied. Over the past year, the fund achieved a total return of about 7% as of November 2024. Its annualized total return since inception is approximately 2.8%. SCHY is a relatively new ETF, so its historical performance data is limited. What we can say is that its portfolio emphasizes large-cap, non-US companies in sectors like financials, consumer staples, and communication services. The dividend yield is currently at near 6%, but this is based on the last trailing 12 months of announced payouts. If we adjust it based on estimated payout in December 2024, its dividend yield is anticipated to be closer to 4.6%. Now let's compare it with SCHD. Remember, both ETFs share a focus on dividend-paying stocks. The only difference is in geographical exposure and historical performance. SCHD tracks U.S. companies with strong dividend metrics. It has demonstrated strong historical performance with a 10-year annualized return of approximately 8.61% as of 2024. It offers a dividend yield of around 3.38%, with a history of robust dividend growth of around 11.94%, making it a popular choice for income-focused investors. SCHY, the international counterpart to SCHD, focuses on dividend-paying stocks outside the U.S. Another good news is that it employs a similar selection methodology, so you can rely on its portfolio. However, there is one downside. Its performance has lagged behind SCHD. This is due to weaker international market performance and currency fluctuations. Since its inception in 2021, SCHY's annualized return has been modest compared to SCHD, with dividends contributing significantly to its total returns. But there's always a catch. Let us tell you why you shouldn't rule out SCHY completely. When the U.S. stock market is at its peak, it is also at risk of increased positions in SCHD. This increase focuses solely on companies in the U.S. Diversification with SCHY relies on international business, so it would help create more wealth in the long run. Return projection of investing $100,000 in SCHD and SCHY. Now let's compare SCHD and SCHY. Say we start out with a principal of $100,000 and have no intention of making any annual contribution. Our first concern would be a return of investment solely in SCHD. Currently, SCHD has a dividend yield at 3.38% and an average annual return of 8.61% per year. Dividend growth is high at 11.94%. After 5 years, you can expect $6,100 per year in dividend income, and your portfolio value will be around $178,000. After 20 years, by capital appreciation and dividend reinvestment, your portfolio will grow to $1.2 million. After 30 years, portfolio value grows to over $5.2 million, totally quadrupling the 20 years figure. As for yearly dividend income, we are looking at approximately $370,000. Now, this is a great result, but it relies solely on the U.S. companies and stock market. We will show you in the next couple of minutes how you can achieve the same results while diversifying your risk to non-U.S. companies through SCHY. SCHY has a dividend yield at 4.60%. Owing to its inception just in April 2021, we estimate that the average annual return will be at around 7%, with dividend growth at around 10%. This is lower than that of SCHD, but it is still impressive in its own right. By investing $100,000 in SCHY today, after 5 years, your portfolio value will be approximately $176,000. Yearly income should also stand at $8,200 per year, notably higher than that of SCHD, but this is owing to the higher dividend yield of SCHY. After 20 years, your annual income will be at $82,000 and portfolio value will grow to more than $1.1 million. Notice how the portfolio value in the case of SCHY is lower than that of SCHD? By all indications, it appears as though the cost of diversification to non-U.S. companies is the lower portfolio value, right? But don't be fooled. In the long term, SCHY will save you. After 30 years, you can expect the portfolio value under SCHY to grow significantly to $5.4 million, even higher than that of SCHD. And thanks to the compounding effect of reinvested dividends over time, annual dividend will also grow to $480,000. So now you can be assured that you don't need to compensate your portfolio value with diversification. By combining SCHD with SCHY, you are not only able to achieve your future retirement plan, you will also be relaxed by a balanced portfolio between U.S. and non-U.S. companies. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.